make sure people want to know what's going to happen when an economic shock happens, what's going to happen to their portfolio. And I use something, I won't bore people with it, something called orthogonalized impulse response functions. Forget about that. All you need to know is what will happen to your real estate portfolio if economic shocks happen. And they happen all the time. So it's very valuable information for the clients.
And we call the market correction here.
All right, something good.
You're calling economic shock, market corrections here. What do you think interest rates? Now, I know interest rates affect everything. Correct. Interest rates affect your ability to buy real estate, and I want to look at real estate from a different perspective. For the average person, that interest rate affects whether or not the average person can afford to buy a house.
Correct. Yes.
Share a little bit about that for our audience.
Yes. Well, if I was to take the United Kingdom, we've obviously had since COVID since the start of the financial crash, interest rates were at rock bottom, and they were for about 12 years before COVID started, and then COVID happened and they went even lower. But then obviously we had the war in Ukraine, and we had the Russian invasion of Ukraine, etc. And that was the main economic shock. Interest rates having to go up because inflation rose, all sort of raw materials, cost of raw materials, etc. increased, and we need to sort of stop people spending. Now, personally, and this is just a personal opinion, and I've got into a lot of arguments with economists and also people, that's a cost problem. It's the cost of the raw material rising. That's not a demand problem. For me, it was not a demand. It wasn't the fact that UK residents were demanding more. It was the fact that inflation was rising because the costs were the cost of raw materials, i.e., oil, etc., from Russia. We're having to find it in less supply than it was, so obviously the price went up, and that was putting pressure on our prices, and everything that raw materials I used to make obviously going to go up. I didn't think that when we were in a sort of recessive period that the government, that the Bank of England, in our case, should have put interest rates up. However, they have done that. Inflation has come down, but that, I believe, is because the price of fuel, etc., has come down for other reasons. So I don't really think that was a sort of a reason to put up rates, because people really have suffered. They really have suffered in the UK. Young people, I was just listening on the radio this morning, young people are not able to buy their own house. Even if they have a deposit of £20,000-30,000, they're still unable to afford their housing because interest rates are so high. And if you put interest rates of 5% onto a capital of £380,000 for a first-time home buyer, that's a lot of money. That's a lot of it's a lot of sort of interest to pay on a mortgage, and people just simply can't afford that. So it's a good thing that it looks like we're now at the top end of that, and interest rates look like they are going to be coming down in the sort of near term. Hopefully, we have another round of the Bank of England meeting, and then hopefully they're going to start putting rates down. We've got inflation down to 2%. That's where we want it to be. So hopefully now the rates will start to go down. People will be able to afford more things and do the things they would like to do. And that's where we are.
And that's the bottom line. You need to have money to be able to spend. And if rates are too high, you're not able to spend. Let's go to another part of the market. We're talking about, I just asked about the individual buying a house. How do these interest rates affect? Two questions. One, where do you think these rates are going to go? And what's the impact on the affluent investor? Because see, they're the ones that invest in properties that are mega-sized structures, multi-unit housing, office buildings, and so forth. How does that affect? What's the effect going to be on them in the UK, but also globally?
Well, for the average person, prices, interest rates going down is obviously it's a great thing, because then they'll be able to spend more, be able to afford more. I think the UK problem is more the fact of a housing problem. There's a massive housing shortage, and that's why prices are so high, rents are so high, etc. If interest rates going down, it's kind of it's obviously a good thing for investors, affluent investors. It's good because they can obviously the markets will sort of pick up on that. Interest rates going down is obviously good thing for everyone. Nobody wants high interest rates. We want to be able to invest more. High interest rates is not investable for sort of FDI people coming into this country, etc. Lower interest rates, it's much better story for everyone, especially with the average person, and more so the affluent investor.
Right. And I think when it comes to the high net worth that buys multi-unit property, even though they're able to maneuver whatever they're, because they have a lot of money at their disposal to buy and sell properties, it still is important to have the right interest rate to buy, the best rate to buy at the lowest rate.
Yes, sure. Yes. It's very important that. I think that's a very important point. Yeah, very, very much so. Obviously, the lower the rates, the more sort of flexible people are, etc. And money changes hands a little bit more easily and a bit more sensibly as well. So I think that's it's a very good thing, definitely.
How are you able to help as an economist? How are you able to help people that are investors that I know they look for you all over the place. Name your company is
Affluent Asset Analytics.
Right.
Yeah.
Now, tell investors how you're able to help them.
Yeah, so they have a wide range of portfolios from the stock markets, whatever they put their funds in. And the way I'm able to help them is to look at the sort of, let's say, offices in Norway, for example. So I take them in 3 different streams: offices, retail outlets, and industrial warehouses. Those are the 3 main areas, and some hotels. And I do a sort of a forecast of 1 year, 5 year, and 10-year forecast. And I look at income yields and I look at rental growth to see how these in specific cities and sometimes even locally, how the forecasts are going to look like over that period of time. And obviously, people look for the highest yields, look for the highest rental growth areas. Obviously, put funds in there. Rent rises are going to be much more investable than possibly an area where rents are not rising so much. So I look at rental growth areas and income yields. So people who put their income in a particular into a particular domain, if they're going to get higher yields, then they're also going to put their funds into that. And I do a whole lot of calculations. It's quite complex stuff. But what I get at is an income yield of, I don't know, it could be 10% of right now. So Slovakian warehouses, that's an investable sort of stock market a vehicle, if you like. So people are able to diversify their portfolios on the basis of the forecasts that I give them. And that's how they're able to use that.
That's very important. Because when you're talking about portfolio, you're talking refers to the individual's assets or bundled assets like funds, like real estate investment trusts or mutual funds.
Yes, there's things like REITs. They could be exchange traded funds. Those sort of investment vehicles that they are able to put their funds in and get the best out of their investment, definitely. But there are other people who are, say, for example, international developers who sort of come to me and say, look, I'm thinking of the new markets, the emerging markets. That's the other area I look at. And they say to me, so where are the emerging markets? And could you also let me know about emerging markets where they're possibly green, more sort of the greener sort of areas? And I might say, I don't know, this is just off the cuff. But Mexican offices are looking quite nice in this particular city of Guadalajara or whatever. These offices are sort of yielding 9.5% at the moment. They're green, they're very good, they're sort of investable for the next sort of 10, 15 years. They look very good. That's the sort of thing I'm looking for. That's the sort of thing I'm looking for. And I would give them a sort of a whole project of why I think this might be the case, rather than just telling them that this is what it is. But there are a lot of sort of many different things that you put into sort of an economic scenario to build a story of this making. It could be the fact that regeneration or urbanization, or people sort of migrating or moving out of an area. There could be many different factors that are contributing to this. But at the end of the day, my work is to get the data, crunch the numbers, and produce a result for them. And that's generally what they look for.
I know you work for Barclays. You've worked for Barclays, and you've worked with Lehman Brothers in the past, right?
I did, yes, correct. As an investment banker, yes.
Competitive environments too.
Yes, very different environments. One is still going, one is not.
Well, that's right, and that happens. That's what the economic crisis did.
It did. Yes.
Investment firms.
I remember that day. I wasn't at Lehman at the time. I was actually working for Commerzbank at the time. And it was a shock to everybody. It's obviously it's not a nice thing to see that kind of thing happening. It was a year of people sort of getting their acts together and thinking what's going to be. Nobody really knew what the world was going to look like after that. A lot of the banks were saved. I think a lot of the American banks were saved. Lehman, unfortunately, was one of them that wasn't. But in this country, we had many of them. Many of them were saved, and taxpayers' money was sort of put in to bail them out. And obviously the governments needed to do that around the world, and they did that. But it was, yes, a very scary time.
Oh, I remember it very well.
Yeah.
I remember sitting at my desk and watching my clients' portfolios sink and having to tell them that this is not the time to jump out, because that's when people want to flee the scene. And the problem is when they flee like that, then they never recover.
Correct, yes.
Right, unless you really are a very strategic or tactical, unless you do a lot of tactical investing, which is more involved in more option trading or that type of trading. But you're buying long-term securities, that's not a smart move to jump out of something like that. It recovers and recovers very nicely. It's just that if you get out too soon, you don't have an opportunity to make the upside when it does recover.
Exactly, and it's knowing when to come out as well. Obviously, you know, if you have long-term securities, then you know it's obviously more sensible to wait for those because it will correct itself, and that naturally does. But yes, don't come out too soon. And that's basically general advice. It was a very, very difficult time for everyone. But you know, unfortunately, from that, the way I look at the European problem with the euro and the countries aligning themselves together, I don't think they've ever really recovered for that. And that's one of the things that I studied many years ago. I said I was going to make do a study to prove that. And as you can see, Europe just hasn't grown as much as well as it would have, and the UK as well, since that time. That economic shock, it would have been a temporary shock, but now it unfortunately looks like a permanent shock. And unfortunately, the United Kingdom hasn't grown anywhere near as much as it would have had since 2008, and that's been a big problem. It has hurt our investments. You know, Brexit obviously wasn't you know the best thing that happened for investments, because people in 2016 just did not know what was going to happen to the UK economy, and obviously then we had COVID. That was a problem for everybody. But these economic shocks have rendered the European countries quite rigid, as opposed to being flexible enough to move themselves out of that state and back into their, let's call it, equilibrium state, because they are aligned together and they just simply cannot move properly. And that's one of the problems from the financial crisis. That shock has now become, unfortunately, a permanent shock. Well, and that's just my opinion.
Is that right? You feel it's a permanent shock?
I do think that it definitely is a permanent shock. I mean, people say, yeah, you know, when you put the euros aligned together, the euro will be stronger. That doesn't matter.